Here's something the financial industry will never put in a brochure. In 2024, the S&P 500 returned 25%, a banner year, the kind of year where everyone with money in the market should have walked away happy. And yet, according to DALBAR's annual study on investor behavior, the average equity investor earned just 16.54%, nearly 9 full percentage points left on the table, not because of a bad fund, not because of some obscure macro event, because of behavior. That gap isn't a 2024 anomaly. Average equity investors have underperformed the market for 15 consecutive years. 15. The last time the average investor actually beat the S&P 500 was 2009, right after the world thought the financial system had ended. The market didn't take that money. Investors handed it over, voluntarily, with confidence. That's the uncomfortable architecture at the center of everything we're about to talk about. The market isn't random chaos that occasionally punishes the unlucky. It's a system, and like all systems, it has design features that favor certain behaviors and penalize others. Beginners don't lose because they're stupid. They lose because nobody explained the actual rules, the rules that aren't in the welcome email from your brokerage app. So here are 5 investing truths that almost nobody says out loud. Not because they're secret, but because they're uncomfortable enough that the people who benefit from your confusion would rather you didn't think about them. Truth 1. Your brain is running software that the market is specifically designed to exploit. This one isn't motivational fluff, it's mechanical. Your brain has 2 operating systems for decisions, one that's fast, emotional, and automatic, and one that's slow, deliberate, and analytical. The fast one evolved to help you survive. It's extremely good at recognizing patterns, responding to threats, and making decisions under uncertainty. It's also catastrophically bad at investing. Here's the specific bug. Your brain weighs losses roughly twice as heavily as equivalent gains. Losing $100 hurts more than gaining $100 feels good. Psychologists call this loss aversion, but the market just calls it opportunity. Because of this asymmetry, when prices fall, the emotional system triggers a pull-to-safety response. Sell. Reduce exposure. Preserve what's left. Exactly the opposite of what long-term returns require. And when prices rise, that same system sees confirmation. A signal to add exposure, to not miss out. Buy high, sell low. Not because investors are irrational, because they're responding rationally to the wrong signals. DALBAR tracked this in 2024. Withdrawals from equity funds happened in every single quarter, including the quarters right before the market's strongest surges. Investors guessed the direction of the market correctly just 25% of the time. 1 in 4. You'd do better flipping a coin. The market isn't punishing beginners because it's cruel. It's just that the system moves on emotions, and the people running institutional money know how to read when retail sentiment is about to capitulate. Your fear is their entry point. Truth 2. Doing your research often makes things worse, not better. There's an intuition that information should help. More data, better decisions. And in most domains, that's true. In investing, it's a trap. Specifically for individual investors trying to out-analyze professionals whose entire infrastructure is built around getting information faster and interpreting it better than you can. The asymmetry is structural. A retail investor reading an earnings report is reading the same document that thousands of analysts processed milliseconds after it dropped. The price already moved. What you're analyzing is the interpretation of the interpretation. By the time the insight feels actionable, the edge is gone. But here's the more dangerous version. Research gives you confidence. And confidence, in a domain with this much noise, is specifically what causes overtrading. Studies consistently show that more active traders underperform more passive ones, not by a small margin, by several percentage points annually. The most active retail traders have historically underperformed the market by around 6 to 7% per year. Not because they pick bad stocks, because they trade too often, incurring costs, taxes, and the compounding drag of being wrong slightly more than right. Think of it like a game where every action you take costs a resource, and the house gets a percentage of every transaction. The optimal strategy for most players isn't to move constantly, it's to minimize unnecessary actions and let the underlying system work. Every trade you make convinced by your own analysis is a bet that you're seeing something the market hasn't priced in yet. Sometimes you are. Over time, almost no individual investor sustains that edge. The uncomfortable version of this truth. In most cases, knowing less and doing less would produce better results. Truth 3. Diversification is real protection, but not during the moments you most want protection. Every financial professional will tell you to diversify, and the underlying logic is sound. Spreading across uncorrelated assets reduces the impact of any single failure. But there's a specific design flaw in how this concept gets sold to beginners. Correlations between asset classes are not fixed, they're dynamic, and in market stress events, they converge. When panic sets in broadly, investors sell everything to raise cash. Stocks fall, real estate investment trusts fall, international equities fall, bonds sometimes fall. The diversification you built for normal conditions provides significantly less buffer during the exact conditions that make you most want it. The 2008 financial crisis is the textbook example. The 2020 COVID crash in March showed it again. Virtually every asset class dropped simultaneously in the initial panic phase before the divergence happened later. Diversification isn't a shield, it's a probability adjustment. It reduces how often you lose and how much you lose on average, but it doesn't eliminate the correlation problem in tail events. The more sophisticated version of this truth is that true diversification requires assets with genuinely different return drivers, not just different tickers. Owning 30 stocks in the same sector is concentration dressed up as diversification. Owning assets tied to different economic mechanisms, duration risk, commodity cycles, currency dynamics, is closer to what the concept promises. Most retail portfolios never get there. Truth 4, the strategy works. The investor usually doesn't. Here's the cruelest number in finance. Take $100,000. Put it in a buy and hold S&P 500 index fund 20 years ago. Do nothing. Don't check it obsessively. Don't react to recessions, elections, or pandemics. Just let it sit. Today, you'd have somewhere around $717,000. The average investor, with that same starting point but making the behavioral moves that DALBAR tracks, the exits, the re-entries, the tactical shifts, ends up with roughly $345,000. Same market, same fund, half the outcome. The difference is entirely behavioral. Everyone knows buy and hold works in theory. The problem is that do nothing isn't a passive experience. It's an active psychological discipline that requires you to watch a number fall 30%, sometimes 40%, and choose not to act. To hold through the news cycle that feels like this time is different. To not move when everyone around you is moving. Most people cannot do that without a structural constraint forcing them to. Automatic payroll contributions to a 401k work partly because they remove the decision. You never see the money. There's no moment where your fast brain can hijack the plan. The strategy isn't the obstacle. Willpower operating in real time against real volatility is the obstacle. Truth 5. Fees are compounding against you the same way returns compound for you. This one is the quietest of the 5, which is exactly why it's so effective. A 1% annual fee sounds trivial. And in year 1, it is. But compound interest operates symmetrically. Just as your returns compound upward over time, the drag from fees compounds downward. On a $100,000 portfolio over 30 years at 7% annual growth, the difference between a 0.1% fee and a 1% fee is approximately $150,000. Not in returns, in the cost of paying someone to probably underperform the index anyway. Actively managed funds charge higher fees to justify professional selection. But the data on active fund performance is brutal. Over a 10-year period, roughly 85 to 90% of actively managed large-cap funds underperform their benchmark index, net of fees. You're paying more to get less, at a rate that compounds year over year for as long as you hold. The fee isn't just a fee, it's a reduction in the base that generates future compounding. Every dollar removed this year is not just that dollar. It's that dollar plus everything it would have grown into over the remainder of your investment timeline. Low-cost index funds weren't a revolution because they were clever. They were a revolution because they removed a cost structure that was quietly, consistently, mathematically extracting wealth from millions of people who never noticed because the subtraction happened slowly. So here's the architecture of all 5 of these truths together. The market is a system. It has consistent, documented, predictable design characteristics. It responds to behavioral inputs in ways that have been studied for decades. The fact that beginners consistently lose to it isn't bad luck. It's the natural output of running the wrong strategy through the wrong psychological hardware without understanding the rules of the environment. Once you see it that way, the framing shifts. This isn't a question of willpower or intelligence. It's a question of system design. Automate the inputs to remove emotional decision points. Minimize fees to protect compounding. Build a structure that doesn't depend on you making perfect decisions under pressure, because you won't, and neither will anyone else. If this kind of breakdown resonates with you, systems thinking applied to financial mechanics, the hidden architecture of how markets actually operate rather than how they're supposed to, that's exactly what 8-bit economics is built around. Every week, we strip complex financial systems down to their core mechanics. No hype, no predictions, just the underlying code that most financial content doesn't bother explaining. Subscribe if you want that. Like this video if it shifted how you see something you thought you understood, and leave a comment with the truth that landed hardest for you. By the time everyone sees it coming, the smart play is already over. The most successful investors aren't the ones who outsmarted the market. They're the ones who designed a system that didn't require them to. They removed the decisions. They minimized the friction. They built something that operated independently of how they felt on a given Tuesday afternoon when the numbers were red and the headlines were loud. The market will always have an edge on your psychology. That's not a problem you solve. That's a constraint you build around. The question isn't how to beat the system. It's how to stop handing it free money.